It's time for this week's Lucia Capital Group weekly video. I'm Rick Plum. You may have heard that the rules for required minimum distributions, RMDs, have gone through some changes, some temporary, some permanent. The permanent change came from the Secure Act, which moved the beginning year for taking your required minimum distribution from age 70.5 to age 72. The temporary change was through the CARES Act, which waived the RMD for 2020. Now that was the one that affected the most people, but it was only for 2020. Now that we've moved into 2021, the RMD rules that were in effect prior to the CARES Act, well, they're back in effect. Well, this means that if you're at least age 72 this year, generally speaking, you have to begin withdrawing and paying taxes on a certain portion of your tax-deferred retirement accounts. If you don't, the penalty for not distributing at least the minimum is a big one, 50% of the shortfall. So here's the big question. Since you're obligated by tax law to remove this money from its pre-tax status and move it to the post-tax world, at what point in the year should you consider taking it? Now here's what I say about that. If you don't need the money and you're only taking the distribution because Uncle Sam says so, it's potentially more beneficial to do it in the early part of the calendar year rather than later on. So why could it be better not to postpone your RMD until as late in the year as possible? Because waiting to take the distribution offers no real tax advantage. The amount that you're required to take out is based on the previous year's ending balance, and it's a done deal. And that amount is based on your age that you'll attain this year. So here's an example. Let's say that somebody has a $10,000 RMD for this year. Where would they prefer to have any potential future growth occur? In the personal account or in their IRA? If the growth happens in their personal account because they took the RMD early, and that $10,000 somehow grew to $12,000 during the year, that $2,000 of growth, it's sitting unsold in their personal account. No taxes have to be paid yet. If their heirs inherit it, that growth receives a step up in basis, and they will not pay taxes on the gain either. That's if they sell it right away. But if you'd left it in the IRA all year, and it grew there, and then you took your $10,000 RMD at the end of the year, that $2,000 of growth is still in the IRA, and it would become part of the balance for next year's RMD, making the RMD higher, and that tax treatment would be at ordinary income rates instead of lower capital gain rates. And if it's passed on to the heirs, it will be taxed to them at ordinary income tax rates instead of being tax-free. Okay, but what if the investment instead went down in value to $8,000? If it's in the personal account, that individual can sell that security and use that $2,000 capital loss against other income, even ordinary income, capped off at $3,000 a year. This couldn't be done if the money had stayed in the IRA. One more reason to take the RMD early, so you don't forget about it. With penalties at 50% of the shortfall, that's something you absolutely want to avoid. Taking it early in the year will eliminate that risk. RMDs can be tricky to deal with, especially lately, with all the rules changes from both the CARES Act last year and the Secure Act from the end of 2019. It's probably a really good idea to go over your situation now to determine when the opportune time for you to take your RMD may be. We do this every day at Lucia Capital Group. Just give us a call. We're here to help.